Believe it or not, not all trading strategies are made equal. So in today's video, I have a tier list and I'm going to be ranking a ton of different popular technical analysis concepts and telling you guys exactly why I think some of them are great and why I think others are completely trash. So let's get right into it without wasting any time. First up, we have candlesticks. This is elite. What do I have to say? If you're trading and you're doing technical analysis, that means you're looking at a chart and you're probably seeing candlesticks. Now, if you know how to read these, you know how important they are. If you don't know how to read these, well, you're cooked and you cannot trade until you understand them deeply. So candlesticks are elite. Next up, we got trends. This is also elite. Just having a basic understanding of market trends, uptrends and downtrends, knowing how to identify them. There's more complex things to them, obviously why they happen, how they happen, but at least to understand uptrends and downtrends, it's elite because it's so foundational to even being able to trade. Next up, we have volume. I will put volume in solid. Now, I will say, if you are a swing trader and you're looking at daily, weekly, and monthly timeframes, this could go as far as great or even elite. Now, if you're day trading, right, on the 1 minute, 5 minute intraday, this could be mid avoid or even death tier, depending on how seriously you're taking it. But I will say it's better for swing trading because when you look at it intraday, there are just certain times of day that always have higher and lower volume. And unless you completely understand those to a T, you're going to get really thrown off by abnormally large volume bars at some points of the day and abnormally small ones at others. And even though that's really normal, if you don't understand that, you're going to be cooked using it. But like I said, on higher time frames, I think it's very useful. Next up, support and resistance. Oh my God, this goes in death tier for me. And it's not because the trades using this concept don't work, but it's a complete pattern trading concept, right? You're just drawing lines and trying to take trades off of that. You need the discretion and you need the knowledge of liquidity and draws on liquidity to basically make this work. So just understanding or learning support and resistance as a concept on its own is absolute ballsack. And people who teach this will cherry pick their trades working, but if their trade worked off a support resistance magical line, it's probably because there was a draw on liquidity on the opposite direction and a liquidity sweep in the direction they needed to take a trade, which caused the reversal in the first place, right? You need to understand ICT concepts if you want to make support and resistance trading work. I'll say that much. Otherwise, it's completely bogus. Next up, liquidity sweep. This is great. If you understand how liquidity works and that the market moves to take stops, generate more stops, and then take those stops, if you understand that dynamic and how certain price points act as a magnet and why once they're taken, you can then expect a reversal, that's like the second or third layer to support and resistance that some people didn't know they needed. You now know you need it if you're watching this video and you trade just off of support and resistance without the additional context knowledge of liquidity. But that knowledge of liquidity and context gives you the discretion available to say, oh, we didn't take liquidity this time. Okay, then this zone or line doesn't matter. Fair value gaps. Great. This matches with trends, right? Why do we pull back in trends? Why don't we just go straight up? Well, because trends create imbalances. So in an uptrend, you'll have impulse moves like a fair value gap that create an imbalance and you need to retest it. Now, once you get to that zone, that's where it's really useful because you can take a continuation play if you start to have a positive reaction off of it, which also, that also combines with candlesticks, like understanding, okay, what is a positive reaction? Well, if you understand candlesticks, then you'll look for a positive reaction in a fair value gap, and it's very useful. And if you completely disrespect the fair value gap, aka invert it, that's also great because then you can expect a reversal, right? So I like inversions. That's the model I use for my entries, and it's really helpful because usually when you trade back into a fair value gap, right, you continue the trend, right? You would expect to have a continuation after the retest because we need to retest. We need to rebalance that imbalance the fair value gap creates. But if we completely disrespect it, that's when it's really useful because then you can expect a reversal, okay? Now, SMTs are solid. For those of you who don't know what an SMT is, it's basically a divergence between two correlating assets. So take ES and NQ, aka the NASDAQ and S&P 500. They usually correlate. Now, sometimes you'll see one makes a lower low and the other makes a higher low, right? And that can be a good signal to long, but only in certain circumstances. Now, if you're using it like a degen and just trying to find every single little one you can on every lower time frame, then this is death tier because you're just forcing it at that point. But if you use SMTs at key levels, for example, previous day low, previous month low, maybe London low, and one asset takes it and the other doesn't, right? Then you can be more high conviction for longs if other factors align in your favor. So that's why in that case, if you're using it only at very important levels that are significant, I would put SMT up in great or elite. But because it's used wrong so much of the time, I would say solid, because it can be hard to know when to actually care about it. Next up, we have draw and liquidity. This is S tier. This is the other layer to support and resistance that actually fleshes it out and helps you understand why you're taking the trades you're taking. If you take out a ton of lows, you're not just bouncing off support. You've taken sell side liquidity. And then if you have a bunch of highs in the opposite area, you're actually now looking at that as a draw on liquidity, which means you can target it, but only once all the sell side, what people call support, gets taken out, right? But the sell side actually needs to get taken out. You can't just bounce in that general range. You have to actually take all the sell side. So once you take liquidity on one direction, draw on liquidity is S tier. Okay, it's completely perfect. Next up, we have AMD, or power of three. It kind of falls into trends in a way. I would say it's great. You just understand market accumulates, manipulates, and distributes. The manipulate, basically just another way to say liquidity sweep. Distribute, basically just another way to say it creates an imbalance or a fair value gap, right? And then you'll do that again. You'll chop, you'll manipulate down into the fair value gap you created, and then continue the trend. So it's like a more complicated way to break down trends, but to use this to take a trade in and of itself can be difficult. Next up, this is a part of drawn liquidity, equal highs. I'd put them in great, or honestly, I'd say elite. Basically, on ES and NQ futures, or maybe gold, whatever, in futures markets, if you have an exact equal high to the tick, especially if it's several candles apart, that's going to be a very good long target. Now, if you try to trade support and resistance, you might think this is a short because it's a double top. That's why all this stuff misinforms you. But if you understand that these are exactly equal to the tick, and this is very rare, right? Like, you don't see this every day, but when you do, this becomes an amazing target for longs. Now, relative equal highs or lows, I would say are solid because it's not exactly equal. And sometimes, there'll be relative equal highs and lows on both sides in periods of consolidation. So it's more about waiting for one side to get taken out and maybe what's under it. Like if there's a bullish fair value gap that you manipulate down into, right, then it can be a really good thing. I would say they're solid on their own, but under the right conditions, they're like elite or great. Data wick. Okay, so data wick is basically a wick that is created after a news release. So like 8:30 a.m. sometimes you'll have non-farm payrolls, CPI, or maybe you'll have the interest rate decision that'll come out like at a 2 p.m. on a Wednesday or whatever, right? Like, you get it. News in the market. Sometimes you'll have a wick on one side, and it needs to be only on one side, that gets left and not taken. You can't really even see it in this picture because the pixels got rendered out. But if you leave a fat data wick and then instantly reverse, you can then use that wick as a target, and I would say it's great, okay? But it cannot get taken out, and it has to form on the exact 1 minute candle when the news was released, okay? So on the 8:30 a.m. candle, you want to see a fat wick, right? Say you zoom up, then you want to see us crash down before ever taking that wick high, and then, and only then, can you use that data wick as a long target, right? So understand that. Fibonacci, I would say it's solid because you can use it to find pretty important things like optimal trade entry or discount and premium. But it can be kind of confusing. So I wouldn't say admit or avoid, depending on the strategy maybe. But yeah, Fib is solid. I would say it's pretty useful. Change in the state of delivery, it's also pretty solid. I mean, it's not as good as fair value gap, inversion gap, in my opinion, but it can be used as an entry model, and you're basically just looking. Once again, it's a signature of a reversal to close below the last series of up close candles. That's a bearish change of the state. And understanding that can be pretty useful, but I think that concepts like liquidity sweep, IFVG combos work a little better. Next up, we've got order blocks. Now I would put these in mid/avoid. The reason I would put them in mid/avoid is just because I feel like the other ICT concepts work so much better, even change of the state or change in the state. But like, you want to be looking for retraces into fair value gaps or inverted fair value gaps, which can create balanced price ranges. Liquidity sweeps, just there's so many other ICT concepts that matter a lot more and get better reactions from my experience at order blocks. So I wouldn't say to avoid them, especially if it's on a higher time frame, significant one, but it's most certainly mid. Next up, we have market maker buy model, market maker sell model. I mean, this is like solid. It's just knowledge of the way the market moves and, you know, reversal patterns, but it's not really something you would take a trade off of in and of itself, but it's helpful to know the concept. Next up, I'll go RSI, and I would say RSI is mid. 90% of the time, it's mid or avoidable. On higher time frames, when there's obvious divergence between RSI and price, is when I think it could be decently useful. Or in those really outlier scenarios where you'll have like a weekly RSI of like 90 or 85 or maybe even higher, then like the risk reward to short that becomes so good. But if you're trading futures, you obviously still have to really time it perfectly. So, I mean, for me, RSI is pretty mediocre, but I have had cases where it's been useful, specifically for swing trading. But I wouldn't say avoid it, I would just say it's mid. Next up, the 921 EMA combo. I mean, this is another one I would go avoid. I would say avoid this. It's just lagging indicators are very difficult, and I see so many people posting 921 EMA trades, and they'll cherry pick examples where it worked, but then like on the chart where they post, you'll see like 3 different times in the day prior where it didn't react off either. Oh, I just hate the 921 EMA thing, or the 821, whatever one you use, even the 8 alone, the 21 alone. I don't give a fuck which EMA it is at this point. They're all really useless on lower time frames, in my opinion, especially on like the 1 or 2. You know what? Since it pisses me off so much to see it all over Twitter, I have to put it on the death tier. It's really inconsistent on its own, and you need to have like other strategies that you're combining it with, and people don't focus on those parts of the discretion behind it. Like, I mean, I'm sure there's some people who profit using it, but that's not the main reason they're profiting. They're profiting more so because they probably are good enough traders to understand price action deeply, which is just all about candles. Okay. Next, VWAP. Now, VWAP I would say is solid. I don't use VWAP as an indicator, but I have been told that there's been research, and I have, you know, there's proof on YouTube and other media platforms that VWAP is actually used in many cases by Wall Street, right? Like, it's a very heavy area for order flow. So institutions do care about VWAP, which makes it fairly useful, I would say, especially to watch how it's reacted to as a maybe signal to either stay in or get out of your trade. I wouldn't really use it to enter like, oh, we break above VWAP. Now I'm going to stay, you know, now I'm going to enter my trade, max leverage. No, but I would say maybe watching how your position you're already in reacts when you get into it could be useful, and maybe tighten up your risk a bit once you approach it. I don't know. It can be good though. I know that because I know that Wall Street actually does care about this. Institutions actually kind of do care about this in some cases. Next up, you have the 250 EMA combo. And okay, on lower time frames, it's mid or avoid. On higher time frames, it's solid, especially like the 200 weekly moving average on the S&P. Historically, if you buy the S&P every time it gets down there, it is super, super beneficial, right? Or any quality stock when it's down to its 200. You can also use this for like death crosses, which I don't think those work very well. The death crosses or the golden crosses, it's not a very high expected value strat, but I would say in certain cases, this can be very good. The thing is, in those cases where 200 EMA is good, it's so rare. Like, look at the, you know, the weekly chart and see how often the S&P actually touches its 200 MA. It's really not common. So when it happens, it's a great high probability trade, but it's just, you can't really build a consistent money making strategy off of it if you're looking for like active income, because it doesn't happen enough. And like I said, using it on the lower time frame is balls. So breakers are mid or avoid for me. I just think it's noise. It is a common and popular ICT concept, but I'm just not a huge fan of it because like it's the same thing with order block. I just feel like other concepts work better. I'm not going to put it death tier because it can work, but I just don't think it's a good ICT concept to base a strategy off of. It's just much more situational than something as fundamental of a building block like a fair value gap or a liquidity sweep. And you could say inversions are situational, but it's just a very good lower time frame entry model. I just feel like fair value gap and liquidity sweep are so ingrained with like the actual structure of the market and perfectly explain why moves happen in some cases. I just feel like breakers and order blocks are more situational concepts that don't really give you any revelationary like explanation as to why certain moves happen, which fair value gaps and liquidity sweeps do, and draw on liquidity as well. Next up, we've got head and shoulders. Now, head and shoulders is death tier. Okay, if you're using head and shoulders in 2026, or if you even used it in 2025, you need to find a new strategy, because the thing with head and shoulders is that you can see the pattern play out, but there's a reason it's happening. It has more to do with an inversion gap, right? Like a failed rebalance or a liquidity sweep of some sort, and then you fail a rebalance, right? And then you'll have something like a market maker sell model where you will come down and retest some type of imbalance you put in at the beginning of the reversal, aka some bearish fair value gap, and then you'll have a continuation, right? It's like a smart money reversal pattern. But if you're just blindly taking a head and shoulders without context of what happened overhead at the head and why the shoulders are even developing, it's going to be useless, because you're just pattern trading at that point, and you won't be able to justify, okay, was liquidity swept? Did we actually rebalance into a bearish gap, or did we just rebalance into chop? Because that's a very different scenario. And then how fast are you coming and making that second shoulder, right? How hard of a rejection is it? Are you even rejecting off a fair value gap? I could go on and on and on, but trading it, like you'll see head and shoulders patterns play out, but if you trade them using ICT logic, it's going to be more consistent rather than just pattern trading every single little, set of bumps you see. Next up, flags. Now, okay, once again, this is mid or avoid if you're trading it as a flag, but if you are trading it with ICT concepts in mind, it's almost like accumulation, manipulation, distribution. But the reason I'm talking so highly on ICT is because it rationalizes the reasons market is making the moves it's making, okay? And people say, oh, don't overcomplicate it. Okay, well, I would personally like to know why I expect price to move in my direction in the first place, okay? So with the flag, why does it actually work? You make an impulse leg up, so you create a fair value gap, which is an impulsive move. There's orders left open, so you need to rebalance into it, aka pull back. Now, while you're rebalancing with the flag, you're often creating relative equal highs, right? Because you're creating lower highs that all are going to be stop points, right? So you're going to have short stops above each lower high. They're going to continue to trail them if they're short here. And then once you rebalance, you can expect these buy orders to fill and propel you up to take out all of the sell orders that you created while you were flagging. That's why, if you think of it in an ICT concept, you're going to be able to rationalize it. But certain times you'll have some type of signature and price that invalidates this being a good long. And if you just look at it as a flag, you won't understand that. But if you look at it as accumulation, manipulation, distribution, and respecting an imbalance, you'll actually take the right trade. So mid or avoid for flag. Trendline breakout, I mean, this is another death tier. If you're just trading a trendline breakout, I'm going to say the same thing as I said with support and resistance. If you're just trading a trendline break without understanding why you expect it to continue and why that was a good spot to short or long, you're just going to not have a high win rate. It's going to be very inconsistent. Not to mention, trend lines are very subjective. You can draw a trend line between any 2 points on the chart ever and act like it's something important. And that's what I despise. Trendline is probably the worst one in death tier so far. I can't lie. If you're only using trendline breakouts, it can be very awful without understanding the context of it. Next up, Hike and Ashi. Bro, okay, once again, if you're using these, what are you doing? Bro, who actually uses these? If somebody uses Hike and Ashis, I'm not even trying to flame you. Can you comment and let me know what the benefit of them is? Leave these in 2020. Double tops and double bottoms, death tier once again, because if you're just trading it from the perspective of a double top and double bottom and not actually understanding the deeper part of it, right? Like whether or not the second high took out the first, aka you had a liquidity sweep, then you could be shorting when you have exact equal highs, and you might think this is a double top when really it's the strongest magnet to the upside ever, and you wouldn't even know it. So it's death tier if you only think of it through this perspective. And if you're doing ICT and you're thinking of drawing liquidity and liquidity sweeps, then you're not going to use the term double top or double bottom. So these are absolute cheeks. Obscure patterns as well. A cup and handle? Really? I have yet to find one person to ever explain to me the reasoning behind why a cup and handle in and of itself is bullish. You don't. You can't give me a reason. Now, if you say there's equal highs above, then anything's bullish. But no, a cup and handle? Are we serious? This is so obscure. There's like bats, crabs, sharks, cups and handles. These are all total noise. My God. New day opening gap and new week opening gap is elite. Okay. Basically on futures, ES and NQ, sometimes you'll have a new day opening gap or new week opening gap. And if it is left unfilled right away and you gravitate away from it, you can expect it to be a very strong draw on liquidity and get returned to. So for that reason, they're very high probability. Now we have kill zones. I would say these are good, solid. You want to know the times of day that it's going to be more high probability to get a good move, which kill zones tell you. ICT kill zones, there's a trading view indicator for it. If you just look up ICT kill zones, it can help. But I will say sometimes people overthink like not taking a really good setup because it's not in their kill zone. And if you do, like, if you're behaving like that, I mean, it's probably like in a mid or a void. I guess everyone has their strategy, but I don't know. I would say that kill zones in many cases are just useful to know. And finally, we have discount premium. And I think this is a great one because basically you just take a fib. So the fib can help with this, right? You take a fib, you draw out a range from a swing high to a swing low, and you want to understand that longs are better in the discount, so the bottom 0.5% of that range, and shorts are better in the premium or the top 0.5% of that range. Now, I will say sometimes you do want to ignore it if the draw is super obvious and you're like a little bit above premium, but you want to long to like a really clear set of equal highs. You don't always have to regard it, but it can be super helpful. And the farther you are in premium, I would say the higher expected value you have on shorts, and the farther you are in discount, the higher expected value you have on longs. So for that reason, I would say that discount and premium is great. Now we have the full tier list, right? Elite, candles, trends, draw on liquidity, equal highs and lows, and new week and new day opening gaps. Those are elite. You should use them. In my opinion, you need to have an understanding of these things, at least these three, right? Like these three concepts, you need elite understandings of to be profitable at trading. Candles, trends, and draw on liquidity. And I would say draw on liquidity is like the second most important thing. But like I said, none of this goes without candles. Equal highs and new day opening gaps, new week opening gaps are still elite though. It falls under the subset of draw on liquidity. It's a draw on liquidity concept. Okay. So liquidity sweep, you could put in elite as well, but I don't know. I think these concepts are more foundational. But like draw on liquidity, if you understand draw on liquidity, you'll know when liquidity sweeps happen. So it all kind of meshes together. Support and resistance, just to go over it again, it's just not useful on its own. You need to be able to rationalize it, which regular support and resistance teachers and systems don't do. So this is the tier list, and this is pretty accurate towards what I use. If you want to know what I use, obviously I use candles, trends, and DOL, and I like to use the equal highs, new day opening gaps. I use fair value gaps for entries and IFVGs. Did I put fair value gap in solid? I meant to put it in great. So like these are all the concepts I use on a daily basis, I would say. Right here, maybe discount and premium in some trades. So for me, subjectively, those are all elite, but I think some of them matter more than others, which is why I separated it the way I did. Now I know this is going to be probably a controversial video. There's some hot takes in here, and yeah, let me know what you guys think of it. Give me comments about your takes on this. I'd like to hear what you guys use, what your strategy is, and all that stuff. And I appreciate you all for watching. Now, if you're serious about trading and you're still watching this video, make sure to like and subscribe so you catch more of my content. I post trade recaps. I post my strategy breakdowns. I have playlists for those things. One of them will be at the end of this video. And also join my free trading Discord. It'll be linked in the description. I post all my daily trade ideas in there for free, swing trade ideas, and I engage with you guys and get back to all of you. So I appreciate you all for watching. I'll catch you in the next one. Peace.